Good morning, everyone, and welcome to the Sirius Report. And Happy New Year to everyone. We are back. As always, my name is Ken Shorgen. I'm here with London Paul. And Paul, good to see you back. Always great to have a discussion with you. And we got some really fascinating topics. One in particular, which we're going to do in this podcast, regarding interest rates, China, the economies, etc.
Yeah, well, obviously, Happy New Year to everyone listening. Obviously, yeah, it's a pleasure that we get back together again, Ken. Yeah, this subject I think is extremely important because it highlights, again, this complete lack of understanding of the reality of China's financial markets, China's economy, even the very mindset of the Chinese people themselves. And this all too frequently is a problem in the West. Sometimes it's deliberate, it's nefarious, it's intended to try and twist people's perspective on what China is, which is frankly ridiculous because reality is reality. It doesn't matter what people say. But also, sometimes there are people who just repeat what someone else has said and don't really understand that, in fact, they are totally and wholly incorrect. And this is another one of these examples. And I think partly this is to do with the fact of the differences between China's bond markets, what we're witnessing, and what we're witnessing, for example, with US bond markets, and how very divergent they are. And that people are trying to explain away what's going on by trying to make all kind of accusations of and statements regarding China and just seemingly ignoring what's happening in Western bond markets in the process.
Exactly. Anyway, this is the crux of our discussion today comes from a post that our good friend Dario put out just before the holiday. It's in regards to the misunderstanding of why China's 10-year bond yields are not a bad thing, sitting at a historic low of 1.64%. Now, taking this into context, our bond yields today are looking at the 10-year 4.691, nearly 4.7%. Why is this important? Well, one, because the US 10-year is up now above what the Fed rate is. And in China, one of the big misnomers, of course, is, well, many in the West and the alternative media, oh, China's economy is going bad, consumers are going bad, they're going to have to deal with this. But the reality is that China and the Chinese people, for the very most part, do not use a lot of credit. They are savers, and they trust their cash and their savings and gold, which we have seen purchased over the last few years en masse, much more than they do buying bonds, buying, or borrowing, using credit to buy something. And even the big businesses, or I should say, not big businesses, big businesses are still using debt for a lot of their work, but the small businesses aren't using it. And when you take a look at the US, almost everything we do is done with credit, not with cash. The US consumer does not have any savings at all. And you can judge this by how big our $1.8 trillion debt is. I mean, just credit card debt alone, $18 trillion in total consumer credit debt. And you take a look in China, where the average Chinese individual has a ton of savings and they don't have any debt. Isn't it fascinating when you look at it that way? If the Chinese use cash when they want to make a purchase or they want to make an investment, and the United States uses credit when they want to do the same thing, doesn't that mean that China is more capitalistic than the US is at this point?
Well, yeah, this is extremely important and it ties in with why China's financial system, its economy, is absolutely not based on Western financialization, as opposed to the West, which clearly is financialization. And Dario makes a number of great points, and I wanted to make this point as well, as did Ken. We both saw this and thought this was a good podcast to discuss things. And principally, everybody knows China has a very strong trade surplus, and of course, what comes with a trade surplus is country, meaning China, has this significant inflow of foreign currency into its banking system, whether that's dollars, rubles, etc., and increasingly not dollar denominated currencies, as we know. And you rightly make the point, Ken, another important aspect that people in the West do not know is China's spending habits, their saving habits. They are very high ratio savers and they accumulate savings in the yuan. And it's very important to say this because there is the very strange idea amongst certain people in the West that Chinese people get all their yuan and convert them into dollars. Absolute nonsense. They do nothing of the sort. Now, the thing is with being high savers and accumulating these savings in banks, that's a problem for banks. Why? Because it's a liability on a bank balance sheet. And the problem as well for banks is because they accumulate these deposits in local currency with little desire for borrowing. And to some extent, that's true even in corporates, Can. Yeah, definitely small businesses, but yes, there are exceptions, of course, but even in the corporate space, there's a lack of desire to borrow. So these deposits stay on the bank balance sheet, which is a liability, as you said. Even those who have decent credit generally don't want to borrow. And zombie companies and individuals who don't enjoy access to credit is for good reason. Whereas in the West, we just give everyone credit because we don't care. And the attitude is, well, if the worst comes to the worst, the government will bail out the lenders, they'll bail out the banks. So what's the problem? Just give everybody, even if they're not credit worthy, access to credit. Well, the Chinese don't have that. So the argument, therefore, is banks and other financial institutions can't really sit on all this large amounts of cash because it's going to impact their profitability as well, because they have to pay out effectively they have to pay out interest on those savings. And effectively, they don't have a lot of alternatives to park all that cash, except, what a surprise, in risk-free government bonds. What does that do? Well, if you keep buying tons of government bonds, you're going to push the yields lower and lower and lower. Now, that's not the entire story. That's part of the story. Let's park the rest of the story for a minute. So China wants to encourage consumer to spend, and also to make investments, but they don't want to create financial bubbles. And they did have a bubble in real estate. Absolutely true. They made a number of mistakes through probably 2014 to 2018, 2019. They've dealt with those problems. They've eradicated these bubbles. And, and that's a sensible decision to do that. And they don't want to create those problems again. And that's another big problem. When we talk about stimulus in the West, we just think of helicopter money or bailing institutions out, just giving people free money, whatever. That's not what stimulus means in China. It's a very different situation whereby the government in China identifies sectors like electric vehicles or high-tech industry and says, oh, you can have all this capital, you can borrow this money dirt cheap. And they're going, do you know what? We don't need this to take out additional forms of debt because we already have significant cash surpluses. We have operating profits. Our business turnover is very good and we're growing organically because we're in marketplaces where there's plenty of space for us to grow into. So this, becomes an additional problem for the Chinese. And what do Chinese retail investors buy? Well, if they're not parking cash in the bank, they will buy insurance products that ultimately buy government bonds, which lowers the yield. And they also put it in safe investments, principally like gold, but to some extent, although it's very small, relatively also in silver, which in these are cultural decisions that obviously Chinese people make. So there's a bit more to say, but I'll park there so you can come in, Ken. But that's the principal reason. It's not the entire reason why bond yields are going down. And we'll come on to the other reasons in a minute.
Yeah, one of the other things, just to add on to what you mentioned, a lot of Chinese are buying investment, like property, et cetera, outside the country. You know, the quote unquote vacation home. We saw this a lot happen in Canada, some in the East Coast or West Coast of the United States, now more in different areas. But buying property outside the country. The interesting thing when you take a look at it too, and I was just reminded about this. Um, we suddenly have Japan, the new prime minister, wanting to make alliances and that and push away the past differences between Japan and China, and you can suddenly see in a very short amount of time a new market that opens. But with that being said, I was reminded of Japan. What is with the United States financialization and Japan? What's one of the most important things of the past of say the 1990s to probably up to the 2008 financial crisis? It was the carry trade. It was foreigners having access to the Japanese yuan, using the currency arbitrage then to buy bonds and then to buy stocks and the whole nine yards. The carry trade was a big thing. Well, guess what? That doesn't occur in China. The U.S. and the West cannot use the strong Chinese currency in their form of carry trade. And there was an article that just came out from one of the more reputable alt media guys. The global dollar share of global reserves hits 30-year low. So not just China, but most of the central banks are divesting themselves of the dollar. So that's going to put more pressure on the dollar no matter. And is it any wonder that Trump is going in there? He probably has knowledge of this, and he's making blatant threats that if you don't accept the dollar's reserve currency, we'll sanction you into oblivion. Well, countries like China, for the most part, are going to sit there and they may be hurt a little bit in the short term, but they have already opened up with the multipolar world other avenues, and it would be the US who would be the big losers if all of a sudden they have to pay more and more and more for products, or in many senses with sanctions, don't get products themselves. The US, because of their debt and because of the fact that we are so consumed with credit and consumerism and that, while the China, Russia, you see this in Africa is slowly becoming a developing nation. They're not a consumerism society. Many of these other countries that are suddenly becoming big, growing and seeing this GDP growth is because they're not consumed with materialism like the West is, and we have pretty much tapped out. And the bond market, the bond yields pretty much reflect how strong and how valuable our currency, each subsequent currencies are.
Yeah, first point worth making, Ken. It doesn't hurt China anymore. China's had 8 years of this with the US and it's failed. So it's irrelevant now from China's perspective. The other point worth making is this has got nothing to do with everybody's piling in to government bonds because China's economy is collapsing. What, 5% growth in 2024 is collapsing? Seriously? Another point worth making, it's got nothing to do with deflation. Deflation is not a problem for China because China's economy is not built on financialization. Deflation in a financialization-driven economy is a disaster. Why? Because it impairs all these assets who have to continually grow and form bigger and bigger bubbles, because if they don't, then the whole game stops, the wheels fall off, financial system collapses. But another point worth making why Chinese bond yields are falling is because China is dumping US treasuries, it is dumping US dollar denominated assets, and it's moving that money into Chinese bonds and Chinese denominated or yuan denominated assets, as are other global South countries in the process. This is an indication of strength, not an indication of weakness. Because here's the point: if it's an indication of apparent weakness in the Chinese economy by yields falling, then they can sit there and go, oh, well, it's not a problem in the West if yields are constantly rising. That's because they're going to then try and sell it to everyone that it's a position of strength, which it isn't either. But more importantly than that is, and what China has to be aware of, if you have banks and financial institutions who are accumulating huge amounts of government bonds, that could potentially cause a risk in the system, because if you get an increase in borrowing demands and it push yields higher, you then risk having mark-to-market losses for banks and insurance companies. So China sat there and went, we can't allow that, the risk of that happening, because that's prudent, intelligent management of your finances or your financial system. They then were saying, well, because if that happens, institutions would have to hold to maturity the asset to avoid losses. And then, ironically, when the desire and demand for lending returns, they wouldn't be in any position to lend because they'd be hamstrung by having to hold all these assets to maturity to avoid making massive losses. Now, to avoid too much demand for central government bonds, Dario points out that China's pushing to securitize local government debt. Why is that important? Because it's been restricted from financing itself through bond issuances previously. Well, that's going to change. So what China will then effectively allow is to aggregate this debt into bond securities guaranteed by the government. That would allow banks and insurance companies to then deploy cash at higher rates, which and also making the debt liquid. That unlocks resources for local governments to pay creditors. It frees up liquidity these creditors can then use to complete projects that currently might be on hold, or future projects that haven't even come into existence yet. The other thing is, and the West loves to say, China's stimulus, China's printing, it's Chinese QE. It's absolutely not, because they're not increasing debt in the overall system monetized by the central bank, but because it's actually hugely beneficial to the Chinese economy, because resources get unlocked and can then be put to productive use. So this benefits GDP growth. But here's the big difference. What does China do that the West doesn't do? They want to grow the economy organically by increasing profitability of businesses, rather than financialization, which is all about creating the illusion of, look at the value in this company. The stock price of company X is 2,000% higher than 5 years ago. This company's worth this. It's not worth anything. It's not based on fundamentals. The Chinese economy is driven by fundamentals. So this will encourage economies to be managed, or the Chinese economy to be managed responsibly, intelligently, and again, this is the reality and something people in the West are just not aware of. It's not a criticism. It's just they've been so geared to believe that financialization is and remains the future of Western economies, which it doesn't. And they don't understand that the Chinese approach is radically different, but for positive reasons and not negative reasons.
For all intents and purposes, you could say that Chinese society is a 1950s America with a 2020 economy. And by this, I mean, in the 1950s, the U.S. was a debtor nation. We had a stable currency, primarily because we still had a international gold standard and a silver standard. Most people were not investing in the stock markets in the 1950s, and they were big savers. If they didn't have the money, they didn't buy it. They were coming out of the Depression. So this is a mindset of the Chinese people, and it's been that way, for the majority of their history. And the key thing is to keep, because of the energy costs that China has with Russia, with uh, OPEC nations, etc. Lower energy. It keeps, you don't have to raise incomes. And this is something that Dario made an interesting point on, I think is really important, is because the West in financialization has to continuously push this thing of inflation. We have to have 2% inflation or whatever, some sort of inflation. That means you're going to increase costs on everything from labor to materials, et cetera. And it just is going to be a spiraling out of control, where instead in China, they've got stable currency, stable energy costs, stable income costs. And so people in the future, once they reach a certain point of savings, are going to be more willing to buy products because they're ahead of the game and they don't have to worry about the cost fluctuation, the currency fluctuation, or all of the things that the United States has to deal with today. And in that, it's going to organically grow the economy.
Yeah, yeah, absolutely. And just a small point I want to make about which, because it does, we are comparing and contrasting US bond markets and Chinese bond markets to some extent. And I read at the back end of last year that PIMCO, now anyone who doesn't know who PIMCO is, they have about a $2 trillion bond fund. It's huge. Now, I read a report that was saying they were hesitant to buy at that time, and presumably 2 or 3 weeks later, it still applies long term US government debt. It wanted to cut its exposure to that debt because of what it termed deteriorating deficit dynamics. And they're favoring buying the short term because the argument is, look, investors can find attractive yields without taking greater interest rate risk. So there's certainly concerns in the US about future interest rates. I mean, and of course, there is a lot of problem because the US federal budget deficit reached about 1.8 trillion when the fiscal year ending the 30th of September in obviously 2024. That was up 8% from the previous year. And if it continues to increase, which it likely will, that's going to put huge pressure on long dated bonds because they're more sensitive to changes in interest rates. And then yields are getting higher and higher. So this is just indicative when you have an institution like that making these statements. I'm not saying they speak for everyone else or everyone else shares that viewpoint, but it's definitely signaling concerns about the long end of the US Treasury curve. And there's no doubt about it that we saw the 10-year Treasury yield rise sharply in October and early November. This was on the back of the fact that everyone thought Trump would win the election. And, he was going to put tariffs in place. Well, that's a separate discussion, maybe for another time. And there was going to be all these corporate tax cuts that would fuel inflation and massively increase the US debt load. But if you have rising debts, concerns about an uncertainty about domestic policies that could slow the US economy, create higher inflation, raise interest rates, and cause problems in the US budget because of higher interest rates, this is going to create uncertainty. And therefore, investors like PIMCO are going, well, hang on a minute. We have to be very careful. It's prudent for them to stick to the short end rather than the long end. And that uncertainty will continue to grow because undoubtedly US debt will keep rising. And if you continue, and I think there was a statement they made where they said if you continue to borrow too much, lenders may question your ability to pay it all back. Well, absolutely, there comes a point when enough is enough. And this is another indication of all the structural problems that exist in US bond markets. But let's not talk about that. Let's deflect attention to China and create stories about China's collapsing when this has absolutely nothing to do with China's economy collapsing. It's for the reasons we've highlighted today.
Absolutely. Paul, I think that's a good place to call this one.
Yep.
As always, I want to thank you for being a part of this great discussion and for your insight.
Yes, and likewise.
And to everybody here at the Sirius Report Plus community, thank you for sticking with us and for all that you do in providing support. Don't forget to like, subscribe, share, comment, send this out to anybody you think would be important to. And until the next time we get together, have a great day.